financial markets, cryptocurrency, gold and silver, world news.
Fair to say you simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We printed digital.
Good day, ladies and gentlemen, and welcome to the show on this Friday, the 8th of April, 2022. Thank you for tuning in. Glad to have you guys here. Now, I've been having a little bit of audio issues. I'm trying to fix them. Right now, I'm trying something a little bit new. And let me know in the comment section if it's any better today than it was yesterday or the day before. So what we're going to do is we're going to get right in there. We're going to talk about what's going on with the Fed right now. The Federal Reserve is making an unqualified error of epic proportions like we've never seen before. They are trying, well, anyway, it's all about inflation right now. And inflation expectations are being stemmed off somewhat by what the Fed's doing in the financial system, even though we're witnessing profound inflation in the real world economy. What that basically means is it's a wait and see attitude by the people who are in finance, whether the Fed can stem inflation off. But you know what they're really going to do is they're going to crash the economy and put us into a recession. This is inevitable if they continue the policies that they're making, and then they're going to have to try to turn around and change monetary policy. So basically, it's kind of like this. It's kind of like if you had a riverboat going down the a riverboat going down the river, big long riverboat, and the river's too narrow to turn it around. But they're going to have to try to turn that boat around, and it's going to ruin everything when they try to turn this ship around. Basically, they're trapped. The Fed's trapped, and we're just waiting now until we see this big turnaround in the Fed. They're going to have to at a certain point. Then inflation's really going to take off. Food inflation is going to be absolutely profound, and these shortages they're talking about, I think there's still going to be food available, but you might not have the selection that you have now, especially in meats. It's a good time right now to stock up a little bit if you got a freezer or someplace to put some meats, because you're never going to see these prices as meat prices start to really rise. Anyway, we're going to get in there and take a look at what's happening in the markets today. And so we're going to start the charts right here. And there we go. It started today. Wow! Okay, so we're looking at the silver price first. And we're up 11 cents on the day so far. But, it's traveling in a very narrow range. And I don't really expect it to make it to $25, at least not in the short term, because it's trapped in this range. Silver prices, you guys been holding silver. You've been waiting an awful long time for the price to pop to the upside, to the blast off, so to speak. Hasn't happened, but I think it's going to happen once the Fed has to change direction or change course. I think this is finally going to happen for silver and gold. And I think they're going to be the ones that really take off first, and then cryptocurrency after, when the profound inflation comes, after the Fed changes monetary policy from this huge blunder that they're doing right now, trying to raise rates this quickly and trying to do quantitative tightening. It just ain't going to fly in the system because, well, they're gonna push it as far as they can now. As long as they can get away with it, as long as the markets don't turn downward sharply, they're going to keep doing what they're doing right now. And so we're going to see a continuation until the markets start to really take a nosedive. So we're looking at a silver price of $24.65. Will gold and silver take the nosedive with the markets when the markets turn downwards? I think crypto might, but gold and silver, no. I don't think they're going to. And in fact, they could actually turn in the opposite direction when the markets turn downwards out of a fear trade. But the fear trade will come if the markets turn downward too sharply, too quickly. So we're looking at a silver price of $24.65. I think that's the third time I said that today. We're going to check gold. Gold is up $13 on the day so far. So gold's looking fairly strong at $19.44. Cryptocurrency today. What we're looking at is a market value, total market value of all the cryptocurrencies of 2004 billions. So that's 2,004 billion. So it's been maintaining lately over the $2 trillion mark for the industry. But Bitcoin price, Bitcoin by itself today is 43,281. So it's been hanging around over $40,000. Let's take a look at the Dow Jones today. And we're looking at up 111 points at 34,695. And it's been holding this pattern. Let me go back here for a long time. Let's go back over 2 years. Now, if you take a look, what you see here is we were at 34,777 way back in 2021. Way back in, looks like May of 2021. And so all this way across here, it's been treading water sideways. Now, we had a couple peaks. We had a peak of 36,338, and we had another peak of 36,327. Coming back on the 11th month of 2021 was a peak, and in the 12th month of 2021, we had those two peaks of around 36,000. But the market's been treading water, the Dow Jones anyway, it's been treading water all this time. And this is a one big long peak in the markets is what we're looking at. And I think the Fed's going to make it turn downwards. But ultimately, when they change monetary policy, we could see this market go up and go up by a lot, but only after the Fed has changed monetary policy. And they're not going to change monetary policy until the markets turn over and we go into a recession that they cause, that they induce this recession that we're waiting for. Let's take a look at crude oil. 96.74 today. It's up 71 cents on the day so far, but we were up to like I was at $113 or something. Let's just take a look at the last, we got the one, let's try a 3-month chart here. And here's the peak right here at 123.70. Wow. And that's when really shot the price up at the pumps. But now if you see, what you see here is we see, if we're doing the chart here from this peak of 123.70, we see a decline in prices come back under $100 for crude oil. Let's take a look at the MOVE index today at 122.67. And the MOVE index has been staying kind of high lately. And if we take a look a little bit longer, we'll go to the 6-month chart. 6 months tells the tale here. And what we see is a MOVE index that started out at 60 and it's moved all the way up. It did have a peak of 140, but the overall trend is upwards for the MOVE index. And this is volatility. So a slow increase in volatility over the past 6 months into the danger zone for volatility in the credit markets. And so ultimately, where do I think this is going? This volatility is going to continue higher and higher until the Fed has to do something about it. Probably in the repo markets, in the overnight window for the banks. They got to keep the banks, this is one of their number one mandates of the Fed, is to keep the banks liquid so that the banking system doesn't go under. Let's take a look now at bonds and rates. And we're looking at these steady climbing yields. Now this is the biggest story of the day right here, is these climbing yields. We got a 10-year at 2.69. It's up 4 basis points today. We got inversions all over the place in the yield curve here. Now, this market is about 10 times bigger than the than the stock market. So this is a huge market, U.S. Treasuries. And when we get a problem with Treasuries like this, and yields climbing, it makes the price for money actually higher. So if you've got money, you can earn more on your money. You can earn interest, more interest on your money, and of course loans are going to make more money. It's going to make more money for the banking system when interest rates go up like this. But at the same time, it also helps stimulate inflation because money has more value for being held, and what this can do is it actually helps to spur inflation as these bond yields rise. The short end's going to rise too, because they're raising it half a basis point each time. And how much can the system withstand before these bubbles start to burst when the price of money starts to go up? You see, when you lower bond yields and you get interest rates down near zero, what happens is this is rocket fuel for the markets. But the opposite holds true. When rates start to go too high, it'll start to crash the markets. And what can the markets withstand before they start to turn downwards? Because ultimately, the people that are in the markets right now, they fully understand that the Fed at some point, what I've been saying, that the Fed's going to actually have to turn around on this and change direction. And so this is one of the things that's holding the markets up. But at the same time, when these interest rates rise, at a certain point, they can make more money than they can in the market with yields if interest rates get high enough. Back in the 1970s, you could make such a high rate of return that if a person had like $100,000 in the bank, just $100,000, they can make well in excess of 10%. So they could make like $10,000 a year. And back in the 1970s, you could live off of $10,000 a year. So if a person just had $100,000, they could live off of their interest that they were making on their. But that was in effect caused by Paul Volcker. And why he did that was to stem off inflation. Now the inflation in the 1970s was not as bad as the inflation that we have right now. And it took several tries of very high interest rates by Paul Volcker before they got inflation under control. What this basically means, and what I'm telling you guys, is that they had to raise interest rates to like 15% back in the 70s. And so they'd probably even have to go higher now to really get this inflation under control. So these rates of 2.69 on the U.S. 10-year, even though they're raising them, the system can't withstand because we're so in debt now. When they raise these rates to service the United States debt, raises that cost. And so then they have to pay that. So how do they pay that? They just print more money. It's a spiraling effect that's out of control at this point. And, my markets have stopped. Well, I'll tell you guys what the U.S. dollar index is. It's right at 100, even right now, if you can imagine that. Anyway, thank you guys for listening to the show. Like and subscribe, and we'll catch you guys in the very next episode, and you guys have a great afternoon. Bye-bye.